Thank you for joining us this evening. My name is Mark McColgan, and I'm the Director of Operations at Practice Evolution Partners, or PEP for short. If you don't know already, at PEP, we help practice owners navigate the complicated nuances of selling to corporate, while at the same time negotiating maximum value on the sale of your practice. So as part of the planning process, we do feel that education is important, which is what brings us here today. So as you'll see on your screen, we have a few special guests ready to go, so I won't take too long. But to help avoid distractions, we've actually turned off the video and audio on your side. That said, if you have any questions, please make sure to enter it in the chat at any time. Or if you'd rather use audio and have a discussion, you can raise your hand or mention it in the chat, and I'll unmute your mic for that time frame. We'll also have time at the end of the presentation, so you can save them for that time if it's completely up to you. In the next week after this, you will receive an email with your certificate of attendance, as well as a link where you can watch a replay of this webinar. For the certificate, I will be using the name that was entered during registration. So if you receive your certificate and if it's not fully accurate, please let me know, because that will help you with your CE credits. So as part of our speaker series, we have financial experts Brian Grenier and Michael Ruthledge here to discuss ways to prepare and for a practice sale and what life may look like after a sale. So I won't go into their introductions. I'll let them do that. So with that said, I will pass it over to you guys.
Yeah, thanks, Mark. Just real quick background. I'm a chartered accountant by background, and then spent a number of years at RBC Capital Markets helping business owners sell their businesses across a wide variety of industries. And now Brian and I are partners, and we run what we refer to as a multifamily office. So we really focus on a small number of families that are ultimately all business owners that either currently run their business, or we've helped them through succession and through exit, and now we're kind of helping them with life after the exit. Brian, not sure if you want to give a quick 2-minute background on yourself as well.
Sure. I mean, my background has predominantly been in the wealth management space for about the last 25 years. As Michael said, we're partners, we're owners in our firm, business owners ourselves. So we go through a lot of the same kind of issues and opportunities that our clients do. So what we're going to hopefully do today is really pose a lot of questions and hopefully get you guys thinking about, what it means to go through that process, pre, post, and then, a little bit longer into the future.
Perfect. Thanks, Brian. Yeah. So to kick things off, what we really want to do is just sort of walk through that decision-making process of, evaluating whether a sale makes sense for you today and preparing for that sale, and then navigating life after a sale. And it's something we go through a lot with our families. And sometimes that evaluation stage is 2 to 5 years, with getting the right management team in place and all these different things. And then, we spend a lot of our time in that sort of life after a sale, and transitioning from an operating business to sort of more of a family financial business. So our discussion today is really on evaluating sale and life after an exit. It's meant more as a discussion, so please feel free to type questions in or raise your hand. The more dialogue, the better. What we really want to do is focus on process. So what's the process for evaluating whether to sell your business? And what's the process for tackling those key questions that follow a successful exit? So our objective is really to help you identify those key questions you want to focus on, provide a framework to answer those questions, because appreciating, what lays ahead can certainly feel overwhelming. So for starters, how do you think through if a sale makes sense for you today? And so, on the slide here, these are really the first few key questions, which when you contemplate a sale, what does this, offer really mean for me and my family? and what does life look like after a sale? And then the follow-up question to that is, can I afford to sell? So really it's a binary question. It's really sell or continue running the business. And so, what you really need to understand is the full implications of each scenario in order to make an informed decision. So what does each scenario look like? So it's a simple question, but there really is a lot to unpack. So when you say, what does this offer mean for me and my family? And when you say offer, whether it's an LOI or you've been given a valuation range and you're contemplating whether you move ahead on that sort of offer or not. Obviously you want to get your hands around what are the estimated sale proceeds based on sort of an indicative valuation range. And, in this case, a normalized EBITDA. You also want to work with your tax accountants and really get a sense of the estimated tax owed on the contemplated sale and how it's structured. And there may be planning to do there. We'll get to that in a minute. But the harder question here is, what are all the things you want your capital to do for you after a sale? And we'll get more into that a bit later, but you kind of go through those different and then the last piece is just following the sale, modeling out a conservative return on that capital base. And so what we find is, very few business owners that are starting down this path actually go through the process of building out an illustration, of really modeling out what that looks like. After tax cash flows, building out how that capital base can grow, and then really modeling in all the things that you want to do with that capital over the next 3 to 5 years. And typically what we find when we do go through that exercise is that business owners are really surprised. They're really surprised by how the capital base can grow, all the different things they can do. And we get kind of eyeballs saying, do we really have that much? Is it really, generally worth this on a conservative projection in 3-5 years? Can it grow that way? But it's absolutely an illustration you need to go through in order to make that decision of saying, you know what, I can afford to retire. I can sell this offer, this LOI makes a lot of sense for my family and I. And then you want to take that illustration and compare it to, a hold scenario, which is, you continue running the business, receiving cash flow from the business, income, dividends, and then exiting, in 5-7 years from now. And then, you can really compare those two financial scenarios, and then of course, evaluate the qualitative aspects of time and, how you want to spend your time. And, is it do you want to move on and not work 5 days a week and those sorts of things? So that might sound very straightforward, but it surprises us and continues to surprise us how many business owners really don't go through that process. They see evaluation and the decision is based on that, but there's a lot more pieces to it and making sure it makes sense for the family. Brian, not sure if you wanted to add anything.
Yeah, I just for us, I find that, kind of a couple of examples. So, we've had a number of people in similar spaces, whether I call them kind of professional, whether it's accountants or dentists or vets, where, there has been a lot of transactions going on in the last little while. And, we've had a number of clients who, after we go through this scenario, one comes to mind. There's, professional. He was like in his I guess early 40s, had a very good offer, wasn't contemplating sale at all. But when we helped him with the model, we modeled out sale, valuation was quite high. Running the business for the next kind of 5 to 7 years till he was, in closer to that 50 range, it just didn't make a lot of sense financially. The math actually worked out better for the family based on their structure and their tax for them to actually sell. We've also had the flip side where, if the valuation's not strong or some of the structures are not, tax is not, that it does make sense. So I think it's a key element. It really helps that, certainly that, that the financial decision, do I want to sell? Do I want to, stop working? That's a different discussion. But this is, I think, the first one you have to go through. So what does it look like? What does the next 10 years, what's the trajectory of my finances look like for the next, 5, 10, 15 plus years?
Yeah, for sure. And and so the next piece to that is really once you go through that exercise and the sale becomes more interesting and the numbers support that, the next question is, do I have the right structure in place? And this one's, can't emphasize this one enough, because it's a conversation you can be having with your tax accountants today. As soon as a sale is on your mind, you should be looking at structure. There's really no downside to looking at it early. If a sale's coming, you're going to want to do it. It's sort of a one-time thing. That said, there is downside of waiting too long. There's generally a 2-year rule in Canada. So anytime you do a tax reorganization, in order for it to be effective, it typically needs to be in place for 2 years before a transaction takes place. And I want to emphasize that because, Brian and I in the last 2 years have seen a few families, great transaction. It made sense for them from a valuation perspective. They had done some tax planning in advance, but because it wasn't in place for 2 years, it essentially wasn't effective for the transaction. Now the transaction still made sense for them. It's not like they wouldn't have done it, but could they have gotten access to a few more capital gains exemptions had it done a bit more proactively ahead of time? Yes. So just want to emphasize, it's something, if sales on top of mind, it's something you should be talking to your tax accountant about. Tax matters, but at the same time, after tax cash is what matters most. So it's funny, the structure is really important. Be proactive and take a look at it, but sometimes we also find ourselves saying the other thing, which is, don't let the tax structure necessarily discourage you if there's an attractive offer at the table and the valuation is very strong. Because we've also had to coach some business owners the other way, where they had unbelievable offers, and although it surprised them, they weren't expecting to sell. We ran the math, and the math still strongly supported to sell because of the multiple they were getting. So it matters. Be proactive about it. If it's in place for 2 years, you should be well set. And one of the things you want to look at in Canada is getting access to capital gains exemptions in the family, but at the same time, letting tax dictate when you sell is also a bit of the tail wagging the dog. So it's an important piece to look at and be proactive on. The last question we sort of have here. Yeah.
So I was just going to jump in on the tax structure. What we also have found in, I think, since the beginning, business owners tend to focus on their businesses, and sometimes they do the easy thing, whether it's a building inside of an opco or they, passive assets sometimes end up. So I do think that if you are contemplating a sale, yes, the capital gains exemption is nice if we can access that, but also, making sure that the business is as pure as possible. Sitting down with your professionals, or, if we're happy to look at a structure if anybody wanted us to, and, identify, where are some of the issues, the opportunities, to, make things a little bit better or enhance the situation. Sorry, Michael, I didn't mean to interrupt.
Yeah, no, it's a great point. The purification is an issue that comes up a lot when we see other passively held assets in the company that is being sold. So that's another strategy and perspective you certainly want to look at. The last point we have here is certainly a more minor point. Do I want to participate in any equity structures? We included this because understanding this presentation is more geared towards dentists and vets, and it's quite common in those consolidator spaces that a buyer will offer a seller to participate in equity structures. I know the VEP team is well versed to advise you here, but what we would always say is, independent of your sale transaction, would you be a buyer at that valuation for those dollar amounts? And what we typically find is that the answer is no. For example, a vet wouldn't be investing 10% of their net worth in one private business in a normal situation. So why would you do it here? That's a bit of the logic we would ask our families when they're contemplating this sort of equity structure. Is it something you would do completely independent of this transaction? So just another quick point there. So again, we want this to be fluid. So any questions on sort of the process of evaluating a sale and what information you want in order to understand and make a decision, just feel free to type or put your hand up, and we're happy to answer those. But really the takeaway here is when making a decision, you really want to try to have a very clear illustration of both scenarios, so that you really understand the implications of the offer that's in front of you, and then you weigh that along with qualitative factors when making that decision. Brian, you want to jump to the next slide here?
Yeah.
So
Sorry.
yeah,
Life after.
so life after an exit. This is where things get a lot more interesting, especially for the business owners that have been business owners for 30 plus years, and you have to start transitioning from operating business of a dentist or vet practice to now a family financial business, and that's a pretty significant paradigm shift we find. So first and foremost, the sale process is typically quite lengthy and can be quite exhausting. Um, everyone's experience is different. It could be 6 months, it could be 12 months. Um, an advisory team can really help minimize that and take the brunt of the work there. But certainly you'll be relieved when it's over, but also potentially overwhelmed by the next sort of mountain of questions that need to be answered. So, our number one recommendation for business owners following a sale is to take a break, take a pause, take a vacation, take time off. It's a exhausting process to go through, and we generally find the biggest mistake we see is people feel like they need to make big decisions as soon as the business is sold. And our general recommendation is to pause and don't make any decisions for the next 3 to 6 months. It's a transition stage, and there's a lot of planning that needs to be done before implementation. The other challenge, which sort of feeds into that problem, is we generally find the wealth management industry is very product focused. We sort of make a joke, it's the ready, shoot, aim approach. Let's just invest the money and then we'll figure out the plan later. And we've seen that create a lot of challenges down the road. The other, since we do have dentists and vets here, the other sort of analogy we make is, when we see this, it's like going to the doctor's office and saying, just give me the prescription, give me the medication, and then we'll diagnose the problem down the road. No one would do that. They know it's crazy. So why do we see it so often in the wealth industry? So we can't really stress this enough is, when you sell the business, slow down and take some time to figure out what your family really wants to do. And we're going to bring up some of the kind of key questions we think you should go through the process of answering as part of this planning process. So, really what we're saying here is plan, then implement. And there's a lot of reasons why it's so important, but ultimately it's about making sure the structure, the tax planning, the implementation, the team, the investments all make sense in one cohesive strategy that actually achieves what you want. Because once it's implemented, it could sometimes be quite difficult to unwind and get out of. Brian, did you want to add anything there?
No, you kind of hit the last point. I said, what we often see is, very product focused, whether it's, lots of life insurance or, another deal, where you create a bunch of illiquidity. Again, what we really try to emphasize with our clients is as Michael said, it's got to be holistic. It's got to work for you for the next year, for the next 3 years, for the next 5 years, for, how does this transition into, money going from generation one to generation two. You can actually plan for a lot of that and then kind of work backwards to make sure that it kind of fits in all those buckets. And once it does, then actually, take the step to implement.
Perfect. Let's jump to the next slide here. Yeah. So these are some big macro, more philosophical questions that we really try to take our families through to start the planning process and kind of create the business plan for that new family financial business. And so for anyone watching this hoping to get, tactical investment or tax advice, I think you're going to be disappointed. And that's simply because there's no one strategy or no one investment that fits across the board. That's just not at all our approach and what we believe. So, these questions should really act as a roadmap and sort of framework for how you make implementation decisions. So, to start off with, sort of life after the exit going forward, what are our biggest concerns? Are they financial? Are they, clarity on what can we or can't we do? Is it family harmony? The kids, concerns about entitlement for the kids? Is it protecting what you've built for the next generation? Is it related to specific assets or real estate? Or is it unwanted risk or sort of a disdain for the stock market? A lot of business owners have always had all their wealth tied up into private business. So it's really going through the process of trying to figure out like what's keeping you up at night. What are the key issues that need to be addressed? The next driver, as it should be, is really mapping out what does the family want, right? Before we get into chasing returns and complex tax strategies, what are we actually trying to achieve? Most business owners have worked 20 plus years for their business, and after a sell, it's really what do you want that capital to do for you, your kids, and even the next generation after that. It's so important that your advisors understand that whichever team you have around you understands that, because any transactional advisor, whether it's a lawyer, tax accountant, wealth advisor, they might be thinking in their silo, well, this is the best way to pay littlest amount of tax, or this is the best legal structure from a family law perspective. But if it's not tying to what you actually want to do and what you want to see the money do for you, it really doesn't make sense. So getting clear on that and communicating that to your team is crucial. It sort of ties into values, again, what matters going forward. Is it freedom? Is it family? Is it giving back, giving the community, all these different pieces? And then, thinking about what help do you need to get there? Like, what's that kind of team? And we have, we refer to this kind of as a family enterprise, and it's, you need to build your trusted team of advisors, whether that's, a tax accountant you've had for a long time or new advisors you feel like you need to bring in. That's really important to sort of get clear on upfront early. And then who should be involved in the decision-making process, both between your advisors and more importantly, within the family. Brian, anything you want to add there?
I think that this piece has really evolved in sort of the wealth management space or the multifamily office space. Traditionally, it was really kind of numbers based, and that's kind of how our industry has always run. But I think that that's changing. It's really coming at it from that top down approach first, that 40,000 foot level, and go. Involving more of the family members depending on their ages. Obviously, the clients direct that, but we have kids sitting on foundations, and we have planning for a child maybe working in the United States. So a lot of these kind of decisions, it's conversations with the advisors, with the family, and the other kind of professionals to make sure that you can kind of achieve what you want to achieve. One of the questions I think Mike had on the slide that we use quite often is in post sale, we say, explain to me what life looks like in 5 years. Like, where are you? Are you wintering in Florida or California? And once you kind of create that kind of picture of what does your life look like or the family's life look like in 5 years, you can kind of work backwards, and I think it helps with that A to Z kind of transition. Any questions or comments?
Maybe let's dive in a bit deeper onto some of the concerns we see most frequently, Brian.
Okay. Yeah.
Do you want to start, Brian?
Sure. So I think that once we determine, that it's financially sound for this to happen, question one kind of usually is a little bit kind of financially driven. I think then it really, for us anyways, it dovetails into, what does this mean? What type of wealth is this? What kind of issues? Warren Buffett, I think, used the quote, we want give our kids the ability to do anything, but not the ability to do nothing. Right. So I think working with the family, helping educate that next generation on finances, is something that is a critical element. Who is going to help you with that transition, that estate plan, which we haven't talked about yet, but it's also a kind of a key element. Making sure that the right tax accountants and people are in place. All of those kind of key I guess concerns, we want to try to deal with them in a kind of a methodical way so that, when you get through that kind of first year or 18 months post sale, you feel really comfortable and confident that the planning is in place to, help that process. We've seen it done well and done not so well. We have some clients who, they, because they've had an exit and they've done well, they support their children, they want to, but it's kind of created a little bit of a catch 22 where, the children have not kind of gone out and really kind of pushed for themselves because they know there's this kind of big number kind of behind them. So, I think what we try to do is work with the families to figure out, how do they want these issues and these questions kind of dealt with, and customize a plan to make sure that happens. But what we see is not generally, do I have enough? We kind of figure that out ahead of time. It's more, how does this wealth change the family? Family law is a big issue in Canada today. If we have used capital gains exemptions, or we are helping the children with money, and the children get involved in a relationship, how do we protect that child and the family as well from potential family law issues? So there's lots of different questions that we try to go through with each individual family to make sure that we dot all the I's and cross the T's.
Yeah, the other piece I'll just add here is just, once the exit does happen and the capital is more liquid, the question of is my, family protected, and, really what do I want to happen if I'm not around? We can't tell you the amount of times we've had clients that, think their will says one thing, but then when we actually illustrate it out, they're really surprised to see sort of that result. And so, anytime after an exit, certainly revisiting your wills and your estate plans is an absolute. And one of the things that we find helpful is really taking the time to go through an illustration of saying, once G1 passes away, this is how the assets flow, using dollars and really getting a real sense for what the will says, because it's a 50-page legal document, and sometimes a one pager can tell you a lot. We've also seen some scenarios. We had one example a few years ago where the father had a very significant estate, wanted some real estate to go to his second spouse, and then the two kids get the vast majority of the estate. But because of tax on the investments, the use of return on capital, so the investments had no sort of cost base, and there was tax owed on the real estate, it ended up that the second spouse ended up with the real estate, which ended up being about 90% or so of the net estate. So there's these scenarios where, if that illustration was presented to the father before they passed away, it very likely wasn't the wishes of the father. And had he seen that, certainly would have made adjustments. So it's just about taking that next step of saying, what does this actually say? What does this actually mean? And does that really achieve our objectives? And, should those specific bequests be there, and really challenging those important questions. All important things to think about, sort of after an exit.
The next slide.
Yeah. So these next couple slides are really just, a lot of people, you'll hear a lot of people say, well, what do you want this capital to do for you? What are your objectives and this kind of thing? And I think that can be a very overwhelming question, especially after an exit. And you really are, we find a lot of clients kind of almost uncomfortable with this shift in lifestyle because they've spent so long compounding wealth and building wealth. Now they're kind of, it takes them time to kind of make that shift. But to help, again, just trying to provide a framework for how I would answer that question. Um, Again, the reason why is we find it so valuable for clients to be very clear on what they want to achieve. So breaking that question kind of down is really, what is the wealth for? Who is it for? When will it be needed? And of all those different pieces, what's optional and what's negotiable? And when you break it down like that, and you could kind of matrix it. So Brian, go to the next slide.
Sure.
So this is sort of the exercise we go through each family, and we've made it very simple here, but it's essentially, so how much of the wealth is for my spouse and I today, and how much of the wealth is for my spouse and I in the future, 3 years, 5 years, 7 years, map it out. And how much of the wealth is for my kids today and in the future, and it could be grandkids as well. And then how much is for giving, charitable giving, or giving to, friends, whatever giving means to you, again, today and in the future. And really, this is helping you sort of build a matrix, and essentially you're taking the same approach a pension plan would take in kind of mapping out your known we'll call liabilities, which is, this is what I want the funds to do for me, and then again kind of tagging as what's optional and what's non-negotiable. And that really acts as a really important input then into how you do your planning, because now you know the horizons and how all the capital breaks out, and what those non-negotiables are. So again, we just want to provide that framework, because sometimes people can ask, like, well, what do you want to do in the next 3 to 5 years? And that could sound pretty vague and a difficult question to answer. But breaking it down this way into pieces, we find quite helpful. And then that can also kind of tie into the estate planning, say, well, this is how we mapped it out, and this is, what it looks like in different scenarios.
Yeah. The only thing I'd maybe add here, it's kind of becomes goals based, and we see it a lot with our existing clients, and depending on the age, once we determine that there is going to be funds for that next generation or for charity, then it's, can I give it now? That's a question I think that, we've certainly got a lot more of. Traditionally when I started in the business, 25 years ago, the kind of the norm was for, mom and dad or kind of generation one to keep their assets. When they pass away and moves to generation two, that's when the gift would happen. But quite often generation two is in their 60s at this time, and maybe don't need that capital. So we're getting a lot of questions and a lot of kind of planning opportunities to pass money intergenerationally while they're alive, and maybe it's even in generation three. So it's the matrix, as Michael kind of outlined there. If you can kind of map that out, then it also becomes, when can I give that? Is that future generation money or that charitable planning? Do I have to wait till I'm closer to passing it on to generation two through death, or can I do it now? So it's just answering those questions, or asking those questions and determining the answers.
Yeah.
Okay.
Great point. And so lastly, I think, one of the things we really believe in is, we refer to it as a family enterprise, and we treat the family the same way you would a business, in terms of, build a business plan, be very clear on the vision, values, and objectives of that plan, and put the right people in place. Whether instead of a management team, it's sort of a trusted group that helps you make decisions. But everything should be driven off of what you really want to achieve, and that can kind of feeds from that matrix we talked about. And again, because sometimes advisors can act in silos, we always continuously ask ourselves, like, why are we doing this? A certain strategy might minimize taxes, but if it overcomplicates your life and if it creates a lot of headaches, that may not be the best strategy. So, all these questions we've gone through should really drive the next part of the process, which is that implementation. It's financial planning, projections, capital allocation, investment strategy, tax strategy, foundation, estate, all those things. It's a process, but it has to start with kind of that family enterprise process, which is, vision, values, objectives, putting the right team in place, and being really clear on what it's for and what the different, well, again, we'll call liabilities, but what the different capital is earmarked for.
Yeah. I think one of the other things that the business plan does is it maintains that clarity. What you'll often find, whether it's, the bank or an insurance or, we saw lots of slide decks invest in, my neighbor's nephew's new business. What the business plan gives you is, you have your roadmap for the next, 1, 3, 5, 10 years. Yes, it will evolve, but it's pretty clear whether or not something will fit in that business plan, and what your goals and objectives and values are. So we have a lot of clients that, where they get kind of pitched an idea or, something gets presented to them, it's very easy to say, hey, this is my business plan is set. Like, I'm not going to move forward with that. And sometimes that's hard to tell a friend or a colleague you've been working with. Michael used the example of, investing back in the consolidator. We saw that a lot on the vet side where the consolidators were, putting together, pitches to, you kind of leave some money in the deal, and having that business plan, as Michael said, would you put 10% of your net worth into a single company, private equity? Probably not. So, I think having that clarity is helpful in so many aspects of moving forward with the process. You want me to go next slide, Michael?
Sure.
Okay.
So, yeah, so this is just a summary slide. So just kind of to reiterate, the key points when evaluating a sale, I think we think it's so important to really make sure you understand the full implications of the offer on the table, not just the valuation, but after tax and what that looks like, an overall plan and sort of illustration of for your family for the next 3 to 5 years to really help you make a decision. Following an exit, our number one recommendation is slow down, really just pause and don't make any big decisions for the next 3 to 6 months. And then take that time to start really understanding what are my big concerns and what are those core objectives? Who's the money for? What's it for? When? What's optional? What's non-negotiable? And take the time to map that out, and that should really be the core inputs to building a really comprehensive business plan for what it will now become the sort of financial family business. And everything you do should really be able to tie back to those key pieces. So that's all we had for our presentation today. Certainly happy to answer any questions if there are any on any of those pieces, or talk further about any points if anyone has anything.
Great job, guys. While we wait here, if we have some questions coming in, how does one get a hold of you guys?
Sure. So I think certainly they can, go through you guys. I know that if they want to get in touch and they have some questions, they can certainly do that. We can also, you have all of our contacts. You can provide that. Probably the easiest way, or we do have a website you can go to. It's CI Private Wealth, and then Michael and I are on there as well.
Great. Yeah, and I'll as mentioned at the beginning, we will be providing your certificates via email, as well as a link to this presentation. So at that time, I'll include that as well. And it looks like we do have a question from Blake. He says, What would you say is the minimum time frame a seller should start looking at reviewing their organization prior to selling?
Yeah, that's a great question. And there's almost I would almost wear two different hats to answer that. One is the tax side of things, which we touched on earlier, which I would say because of the rule in Canada where anytime you do a reorganization, that organization needs to be in place for 2 years in order to be effective. I would for sure say, you want to look at making sure you have the right tax structure set up more than 2 years in advance of close. So, generally speaking, the sooner the better for that. And the other point Brian made is sometimes it also means purifying certain holdcos.
Yeah.
So that's something where there's very little downside in being proactive about it. And talking to your tax accountant as soon as sale is top of mind. And then there's the other piece to it, which I think Mark and the team would be better equipped to answer. I can answer a little bit from my M&A days with RBC, but really it's then for sure a year in terms of really looking at the business, the quality of earnings, getting a real sense of normalized EBITDA, making sure the right management team is in place. There's a lot of operational things you would want to look at to really make sure you can get the biggest bang for your buck from a valuation perspective from the business side of things. But maybe I'll let Mark and the team add to that.
Yeah, Mike, you still there on there? Mike might have better thoughts on this. I mean, that's a great overview to me. And if you do want to reach out to us, you can reach out to admin@practiceevolutionpartners.com. And we can also get that information for Brian and Michael through that as well. Yeah, I don't think we got Mike there. So
Yeah,
I can jump in. I just think you want to put your best foot forward. So, you don't want the potential buyer, I mean, listen, we see it all the time in different businesses, the extra dinner or, whatever expenses run through, depending on the aggressiveness of the account, you want your math to be as clean as possible. If you have a clean, income statement, a good balance sheet, it certainly makes the process go a lot simpler. Once they kind of find something, they're going to dig. So, we'll often tell them that, if you are going to do that, make sure that you can defend any sort of expense or any sort of extraordinary item in there.
yeah, good point. Real good point.
Yeah, great question.
Anyone else before we let these guys go? Oh, yeah, we got one. So Dominic asks, my, in brackets, limited understanding of the lifetime capital gains exemption is that when a capital gain from the share sale of a practice is exercised, it is not that the sale is explicitly tax-free, but that some form of tax obligation is initially due, and that afterwards the seller has the ability to reclaim the taxes paid through tax credits. Could you guys provide any commentary on this topic, as well as to clarify any inaccuracy in what he's saying? He or she.
You want me to go first, Michael, or?
Sure.
Sure. So, in a nutshell, what happens? You have to own direct the shares that are going to be sold, or you can do it via a family trust, as long as it's been in place for 2 years. But in a very simple scenario, I own shares of XYZ company. It's been my business for a long time. I'm going to sell XYZ company to Mark for $3 million or $5 million. As long as you meet the tests, and there's a couple of other tests that make sure that you're qualified, for the capital gains exemption. The first approximately $890,000 is.
Sorry, 913 now.
Oh, is it up? It moved up again? Sorry.
Yeah.
Thank you.
No worries.
So the first $913,000 of capital gains are not taxable. So if you had a zero cost base and you were selling for $4 million, and you were able to use your exemption, you're going to have 913, or call it 900, keep my math simple, tax free. You're going to pay tax on the next 3.1 million. That's going to be taxed as a capital gain. Currently in Canada, there's a 50% inclusion rate. So depending on the province, it's kind of works out to between 24 and 26% is your kind of net tax on that gain. So that's generally how it works. If there is an opportunity to have multiple exemptions, if a spouse owns shares and again they qualify, or shares are owned through a family trust, and you can do that. You can multiply your capital gains exemptions. We've seen through some planning 5, 6, 7 exemptions be used. The one caveat there is if you do use somebody's exemption, I use my child's exemption, for instance, that money is theirs. So on their tax return, they're going to claim a capital gain, and there's going to be some alternative minimum tax, a few kind of nuances, but that's an obligation to them. So whether it's through a trust or direct, that capital is theirs. So that's one thing that we find a lot of tax kind of accountants. We actually saw one family trust planning that they had, I think the number was 52 people in their family trust as potential beneficiaries. And forget about the nightmare of trying to administer that family trust. But 52 capital gains exemptions, yes, you can use them, but there's an obligation to give them that money. So that was something that wasn't really explained to them. There is no gift back. You could do it over time, but there's something the CRA looks like. If it's not a real transaction, they're going to actually come after you. So we want to be as clean as possible in that scenario.
Yeah, so I think the summarized answer is, certainly the lifetime capital gains exemption is absolutely a major tax benefit, and if you and your spouse hold a company and are both eligible for it, it is a pure tax savings. To Brian's point, there's opportunities to tax planning you can do to use more beneficiaries' lifetime capital gains exemptions. But with that comes the very real obligation that the money is legally theirs.
Or at least the taxable portion.
Yeah.
That's great. Anyone else out there? Dominic, hopefully that answered your question. Yep, thanks so much. All right, guys. Well, we're coming up on an hour here. So I think if we don't have any questions, we'll stop it there. I do want to thank you guys. That was great. And just to reiterate, we will have this this presentation on video. Once we get it all edited, I will reach out to everyone with their certificate for their continuing education points, and also I'll have a link to that there. Mike popped on there. Do you have anything, Mike, that you wanted to add?
No, just thanks for everyone for joining. Hopefully everyone found that useful. Reach out to the guys if you have any questions. They're a wealth of knowledge and can help you with anything you need.
Yeah, and if you need help finding them, as I said, admin at practiceevolutionpartners.com, and we can hook you up with that. Or if you have any questions for us, we can help you there as well.